Go. Okay. Okay, everyone, I'd like to call this meeting of the Standing Committee of the Alberta Heritage Savings Trust Fund to order and welcome everyone in attendance. My name is Garth Rosewell, MLA for Vermilion Lloydminster Wainwright and the chair of the committee. I'm going to ask that members that are joining the committee at the tables to introduce themselves for the record, and then I'll go and see who's joining by video conference. So we'll begin to my right.
Good morning, everyone. Tracy Allard, MLA for Grand Prairie.
Good morning, everybody. Brittany Jones, Government of Alberta.
Lowell Epp, Department of the Treasury Board and Finance.
Good morning, Nelson Roby from with the Auditor General's Office.
Good morning, Brad Ireland with the Auditor General's Office.
Good morning, my name is Dave Egan. I'm the MLA for Edmonton Northwest.
And good morning, Christina Gray, MLA for Edmonton Millwoods.
Good morning, Trashman Koenig with the Parliamentary Council Office.
Good morning, Nancy Robert, Clerk of Journals and Committees.
Good morning, Warren Huffman, Committee Clerk.
Okay, we'll go virtually now to the MLAs that are online. So, Mr. Jones.
Matt Jones, MLA Calgary Southeast.
MLA Hunter.
Yeah, MLA Grant Hunter, MLA for Tabor Warner.
MLA Phillips.
Shannon Phillips, Lethbridge West.
And MLA Singh.
Good morning, everyone. Peter Singh, MLA Calgary East.
Okay, and then we'll invite the people from AIMCO to introduce themselves.
Good morning, Amit Prakash, Chief Fiduciary Management Officer.
And good morning, everyone. Sandra Lau, Co-CIO, Head of Public Investment, AIMCO.
Good morning, James Barber, Co-CIO, Head of Private Investments.
Okay, and we've got they've already introduced themselves, so we're good. Okay, so, and there was no substitutions today, so don't need to do that. So a few housekeeping items to address before we turn to the business at hand. Please note the microphones are operated by the Hansard staff. Committee proceedings are live streamed on the internet and broadcast on Alberta Assembly TV. The audio and video streams and transcripts of the meeting can be accessed via the Legislative Assembly website. Members participating remotely are encouraged to have your cameras on while you're speaking and your microphones muted when you're not speaking. Remote participants who wish to be placed on the speakers list are asked to email or send a message in the group chat to the committee clerk, and members in the room are asked to give a signal to the chair or the committee clerk. Please set your cell phones and other devices to silence for the duration of the meeting. A draft agenda was distributed to all members. Does anyone have any changes or additions to the draft agenda? Seeing none, would someone like to make a motion to approve the agenda? MLA Allard? All in favor in the room? Anybody opposed? All in favor online?
Aye.
Aye.
Any opposed? Okay, thank you. Motion is carried. And minutes, next we have the draft minutes of our January 25th, 2022 meeting. Do members have any errors or omissions to note? Hearing none, would someone like to make a motion to approve the minutes? MLA Allard. All in favor in the room? Okay. Is that an aye? Okay. Any opposed? All in favor on a virtual?
Aye.
Any opposed? Okay, thank you. The motion is carried. The Alberta Heritage Savings Trust Fund third quarter report for 2021-22 was released on February 24th, 2022, and the report was posted to the committee's internal website. As committee members are aware, the Alberta Heritage Savings Trust Fund Act mandates that the committee receive and review the quarterly reports on the operations and results of the Heritage Fund. Before turning to our guests, I'd like to thank AIMCO for their written responses to questions asked at our last meeting on January 25th. I would now turn it over to Treasury Board and Finance and AIMCO to begin their remarks on the third quarter report, and then open the floor to members to ask questions.
Thank you, Mr. Chair.
Yeah.
And good morning to everyone. It's good to be here and talk about the Heritage Fund again today. First thing I need to note is that we discovered an error in the statements that we distributed. On the near the top of page 2, in the first table called 12 months rolling returns as of December 31st, 2021, the policy benchmark line you'll see is 11.9, 12.9, 13.9. Life isn't that clean that it goes up by 1% every year. So something happened, and we will be distributing corrected statements later today and posting them online. So my apologies for that. So the fund performed well in the third quarter, and it earned a return of 6% during the quarter. Many of us would love to have a 6% return for the whole year, but so the fund had a very good quarter. This is about 1.5% above the fund's passive policy benchmark. So far during the fiscal year, the fund has earned a return of 14.5% compared to 9.4% on the fund's benchmark. In other words, the fund would have earned 9.4% had it been invested passively during the first 9 months of this fiscal year. Another way of looking at it is that AIMCO added or improved the fund's return by 5.1% so far this year. While short-term results are important, the fund is invested for the long term, and investment returns over an extended period of time are more important when evaluating fund performance. Over the last 5 years, the fund has earned a return of 8.8%, 40 basis points above the 8.4% return on the fund's policy benchmark. In the last 10 years, the fund's return has been 10.2%, exceeding the benchmark's return of 9.5% by 70 basis points. The Heritage Fund has two investment objectives which are used to evaluate performance. The first objective is to earn a real rate of return of 4.5% over 5 years. In other words, a return that is 4.5% above the rate of inflation during the 5-year period. During the last 5 years, the fund has exceeded this objective by 2.5%. The markets have been very strong during the last 5 years, and the fund has benefited from that. Inflation was 1.8% annually over the last 5 years, so the target return was 6.3%. The second objective is for the investment manager, or AIMCO, to add 100 basis points, or 1%, in value added through active management. Actual value added during the 5-year period was 0.4%, 60 basis points below the value added target. Now, I will note this is a difficult target and a challenging target to meet, and we are working with AIMCO to improve this, the value added. Lastly, in terms of income earned, the Heritage Fund has earned $2 billion so far this year. Of this amount, approximately $440 million is expected to go or to be retained by the fund for inflation proofing, and the remaining $1.6 billion will be transferred to the government's general revenue fund. This concludes my remarks. Thank you.
Okay, well, thank you very much, and now we'll go to AIMCO for their report.
Good morning. I will start and then turn it over to my colleagues, James and Sandra, for their brief prepared remarks. So it is a pleasure to be here this morning. As part of my remarks, I will speak to two specific topics. So one is corporate strategy. AIMCO reviewed and refreshed its corporate strategy over the last couple of months in consultation with clients, in consultation with other stakeholders. And now we're squarely in the mode of implementing the strategy. And at a high level, the strategy has three main pillars. The first one is clients, and where we will push to become a more client-centric organization and to deliver on the promises to our clients. Secondly is to continue to grow and evolve a customizable investment platform that allows us to do that effectively and transparently. And lastly, do that with a team where we are focused on developing a high-performing client-first culture. The second update for the committee is that our CEO had announced, again late last year, some of the executive positions that needed to be filled on the back of retirements, departures, etc. So these included the Chief Risk Officer, the Head of Human Resources, Chief Technology Officer, etc. I'm pleased to announce that by the end of this week, all of the positions, all of the executives will be in their seat. And then the last executive appointment, the Head of Human Resources, she will start in middle of July. At that point, the executive team will be in place, and that will further reinforce and abet our ability to execute on the corporate strategy. With that, I will turn it over to Sandra for her remarks. Sandra.
Thank you, Amit. And thanks, everyone. And thanks for having us today again. Just a quick intro. Co-CIO Sandra Lau of IMCO, Head of Public Investment, 25 years investment experience and 23 years experience with IMCO. Prior to my appointment, served as EVP of fixed income asset within IMCO, overseeing 45 billion of public and private fixed income asset on behalf of the IMCO client. Again, it's really pleased to be here today to share with you and report to you the Heritage Trust Fund, the fund performance as of Q3 for December 31, 2021. And like Lo share with you, is really mark a strong quarterly performance and translate to extremely strong fiscal year-to-date performance, 12 months rolling performance, and extending into a 5-year and 10-year performance as well. Now, in terms of a little bit of the backdrop of the economics backdrop and market backdrop over what we see in the last quarter or the Q3 of 2021, and even over the 2021 12 months horizon, we actually witnessed quite a lot of topical issue. More optimistic with the reopening of the economy that we saw in the middle of the 2021, and later on of the emerge of the Omicron variant in the later part of the year. More uncertainty of the inflation pressure and also economics recovery, and turn into more policy uncertainty of the monetary policy. Oh, I would say that with this type of backdrop, market was actually very resilient. The overall stock market returned about 6% over the Q3, and translating into almost 17% of a 2021 stock market performance in general. Interest rate market or bond market has been pretty flat over Q3. However, 10-year interest rate in Canada actually went from 70 basis points to 1.4% over the year, just partly to do with more hawkish tone of the central bank in an attempt to control inflation, leading to a negative return of the overall public fixed income market that we saw. Like Lo shared with you, this translates to extreme strong quarterly performance of the Heritage Trust Fund. And I will highlight two things, especially over the last 12 months of the December 31, 2021. The fund return, again, extremely strong return of a 19%. Outperforming the benchmark by 8.3%. And this translates to an extreme strong 10 years long-term return of 10%, value adding of 70 basis points. The value add target is like Lo share with you is a very tough target. However, 70 basis point of a value add, it's almost hitting a top quartile manager performance over a long term. So this is really a result that we are pretty pleased to share with you. In terms of the performance, actually the strong performance from the Heritage Trust Fund, every asset class within the product and within the portfolio contribute to this type of strong performance. I would say especially from the asset class such as the real estate, private equity, infrastructure, and public equity. On the private side, we actually see a lot of improvement on the valuation. We also took the opportunity to sell down some of the asset, realize some of the gain with a couple of extreme strong investment that we have invested on behalf of our client over the last couple of years. Public equity market continues to be strong. However, the team actually add additional 5% more of the value add to the public equity portfolio and delivering strong results to the client because of the prudent portfolio construction and stock selection that we did on behalf of the client. So a lot of you will be aware as we turn into 2022, market took actually a very sharp turn because of the continuous inflation pressure that we see, geopolitical uncertainty, Russian-Ukraine situation, COVID-related lockdown in China. There is more inflation pressure and the uncertainty of the market, even economics recovery. Central bank actually turned way more hawkish into 2022 with the attempt to control inflation. Market was actually generally very concerned with that of the central bank being too late or being too aggressive with the attempt, and that may even lead to a recession environment or even worse of a stagflation environment. So as you can see, probably in 2022, the market actually turned more volatile, and we also see a very sizable sell-off in both stock and bond market. With this backdrop, as a long-term investor, we continue to be laser focused on how we invest on the best interest for our client. So I will ask my colleague James Barber to comment on what are the top risks we are focusing on and how we position ourselves in this type of backdrop. James?
Good, thanks, Sandra, and good morning. So my name is James Barber, co-CIO and head of private investments at AIMCO. Maybe I'll, given it's the first time I'm meeting with this committee or presenting to them, I'll give a quick background. I've spent more than 25 years working in investment management and financial services in a number of different roles, spanning across multiple asset classes, asset allocation, research, portfolio management, investment process, risk management roles. Prior to this, I was the EVP responsible for public equities at AIMCO, and before that, spent about 10 years at Russell Investments as CIO of the equity platform there. So I'm excited to be working with Sandra as co-CIOs as we kind of lead the investment team and develop the platform and prepare us to be able to deliver outstanding investment results over the coming years. As Sandra mentioned, we're moving into an environment which is certainly, the way I think of it, is the expected returns have come down and the expected risks have gone up. And so as we think through that framework, there's a couple key ways we think of the risks, and it's really across three kind of dimensions. One is the economic risks, two would be the geopolitical risks, and the third would be other related risks around cybersecurity. Obviously, the COVID would fit into that, as well as market liquidity disruption. Within the economic risk perspective, a couple key points we're really focused on there is obviously stagflation is front and center. This is not something we've experienced for multiple decades, but is very real, where we have rising inflation and falling growth, and that is a particularly challenging scenario. The central bank policies are currently very active. Some may argue that they've been a little late to the party in terms of actually tightening conditions, and now find themselves in a really difficult position with slowing growth and having to rise rates to tame inflation. With respect to that, that's also would be risk related to currency and the stability around the dollar, as well as certainly some of the pegged currencies from the emerging market side, as well as what China does with its own currency. From a geopolitical perspective, two big issues front and center. Obviously, having a prolonged Russia-Ukraine war is not conducive. Now, while this is a relatively small impact on the financial markets, both of those countries representing very small investable portions, certainly in the public markets, both in equity and fixed income. But I think what we're quickly realizing is that those have a much more significant impact on the underlying economies in terms of energy security, as well as food. And that is something that's been propagated throughout the system and causing some supply shortages and price spikes as a result of that. And then the second is the China and the implications of their political and economic policy. Clearly, in the middle of a COVID-related lockdown, is adding to potential risks around economic activity and trade and supply disruptions, but also longer term, strategically, the politics, specifically as it relates to Taiwan, is a potential flashpoint. And then in terms of the third pillar of other risks, COVID is clearly something we've been dealing with for 2 years now. And while in many markets and countries seem to be through the worst of that, there are still many parts of the world that are under lockdown or dealing with significant issues around that. So you might ask, how do we position ourselves through that? We are currently relatively cautious. We're using about 66% of our active risk budget, so lower than expected or normal. We have a comfortable position in terms of stress liquidity, where that ratio is about 300%. So, somewhat cautiously positioned. And I think part of that has been able to be benefiting of the last several years in terms of the recovery and in terms of the strong markets, but currently being much more cautious, increasing the risk. So tactically, we're fairly neutral relative to the benchmark at an asset allocation perspective. We have some reduced equity market exposure, and we have some tail hedging positions in place to protect on the downside, which have actually proven to actually be value adding this year. These were things that were done towards the back end of last year. In the public fixed income side, we're a shorter duration, and favoring shorter maturity credit risk over longer duration, improving, making sure we have plenty of liquidity in that, and building out a diversified portfolio across different credits space. In the private mortgages, similar themes there, where we're preferring higher quality. Those people that have lower leverage are the ones that we're focusing on. We're trying to expand the geographic presence there as well, and that's a theme across a number of asset classes, is really expanding across a broader APAC region in the assets. Public equities is an area where we've focused on having high quality, reducing the equity beta, and lower volatility of operating margins, and that's enabled us to not only do relatively well last year, but into this year, as the markets have been obviously sold off, we have still been able to outperform in that environment. Infrastructure, when we talk about some of the private asset classes, infrastructure also higher quality, more core-like assets and opportunities. We don't believe we're getting paid for taking on higher risk in many of these assets, and so feel like it's not prudent to do that, and we'll wait until we think we can get compensated for that. Similarly, in real estate, an area where we've been moving towards residential and industrial areas that have a greater ability to adjust to high inflation, meaning their rentals and the leases reset more quickly. So if your lease is renegotiated every year, it gives you a capacity to increase that. If you have a 5-year lease or a 10-year lease, it's obviously very difficult to keep up with inflation in that environment. And so the portfolio has been positioned much more towards the shorter duration of those assets. In the private debt and loans book, that is primarily focused on the private credit side of things, where typically more floating rates, so shorter duration, and high yield credits. And that portfolio is also looking to increase their APAC exposure, currently only around 8% of the portfolio. So in the coming years should look to increase that. And then finally, on the private equity side, is an area we continue to increase capital deployment through our fund program, focusing on middle market and buyouts. That strategy has been performing very well. Some of the capital has been returned probably a little quicker given the buoyant markets we've had over the last year. So we continue to grow in the growth equity in the secondaries market, and developing some of the best relationships we have to continue to deploy capital, and also look for opportunities and broadening out that book geographically. So with that, I will kind of pause and maybe hand it back to the chair.
Okay, well, thank you very much for your presentations. And before we open it up to the floor for questions, I just would like MLA Rain to introduce himself as well.
Good morning, Pat Rain, MLA, Lesser Slave Lake.
Okay, thank you very much. And the way we'll handle the questions, we'll just alternate back and forth. There'll be an initial question and then a follow-up after that. So we'll start with MLA Phillips.
Yeah, hi, good morning. And thank you for that pretty detailed overview. And some of this, some of the questions that I've noted down around inflation, Mr. Barber, you have touched on already. But I just want to talk a little bit about go into inflation a little bit. And maybe you can provide us with a little bit more detail. So you talked a little bit about repositioning some of your investments around in the real estate space in this period of higher sustained inflation, but we know that reality also has an effect on things like fixed income and so on. Can you tell me a little bit more about repositioning the fund for this period of higher sustained inflation, and kind of along with that, if you could maybe talk a little bit about how you're seeing higher sustained inflation in other places? We know that in Canada is actually, I think, less affected than some other places. I was just looking at Germany's inflation numbers yesterday, for example. So if you could talk to me a little bit about some of your global investments and how they are being repositioned because of this higher period of sustained inflation.
Sure. Thank you for the question. So I'll make a couple quick remarks, and then I'll hand over to Sandra to comment as well, particularly on the public fixed income portfolio and how we've adjusted that. I think one of the challenges we find with inflation right now, there's typically three drivers of inflation. It's either because of increasing monetary supply or easy monetary conditions. The second would be supply side shocks. So you have a shock in oil supply that gets cut off that could cause prices to increase. And then the third is excess demand growth. And if you think about what's happening with COVID as we're coming out of the doldrums there's the demand is increasing. The challenge we face right now when we look at inflation is that all three of those have been contributing. We've had very easy monetary conditions for a number of years, which have pushed up asset prices and pushed up inflation. We've had multiple supply shocks from COVID and from Russia, Ukraine, and we've had this excess demand all happening simultaneously. So one of the concerns we have with inflation is it is pretty widespread. It's in the energy complex, which then finds its way through the economy, anything that gets transported. It is in anything that is imported. On the supply side, it's impacted by food, tracing that back to Ukraine, and so we're finding that find its way into wages and wage expectations and demands as well. So it's actually going to be, I think, we're most certainly past that stage where people were talking of this as transitory and temporary. It's going to take a little bit of time and unfortunately a little bit of pain, I think, to actually modulate and moderate that inflation. It is global in nature. Some countries are obviously more impacted than others. Europe, particularly their dependence on the energy sector and exposure to that have been probably impacted a little more negatively, and partly because they've had lower growth to start as well. So the tension we're facing is inflation and growth as well. So that's maybe a little bit more color on inflation and how we see that the backdrop. In terms of the positioning with respect to, I think you asked around real estate. So that is something, as you can imagine, is a long-term investment program, and so it evolves slowly. And over the last couple of years, we have been, moving that portfolio more towards things like residential, more towards things like industrials. And even within industrials, it might be some of the other asset classes, like getting exposure to life sciences, getting exposure to data centers, getting exposure to the entertainment industry in terms of producing content and studios and things like that. So certainly broadening out the diversification in the portfolio and moving towards things where we see significant demand growth and shorter duration on assets. So that's a multi-year program and a multi-year strategy. So maybe back to you, Sandra, in terms of the fixed income.
Yeah, I will be extremely quick for this question. Thanks for the question. And in terms of this asset allocation perspective, I think the portfolio is actually very well positioned itself for inflation, especially if you think of real estate asset, infrastructure asset, they are designed for inflation protection. Now, most of the asset will be coming from fixed income, which is a very right call, because on a rising inflation environment, interest rate usually head higher and usually negative for fixed income asset. So for the shift of the fixed income and into the real estate, the infrastructure asset is actually a very prudent call and asset mix for protecting the portfolio going forward on the inflation sensitive environment. The other question that I want to touch on is about inflation around the world. It's true that we are seeing disbursement of inflation around the world, 8% in US, 6% in Canada, even lower inflation in China. So this actually lead to more different type of monetary policy or political diversion across different countries, and further emphasize the importance of geographic diversification. And this is the importance of how to construct a good portfolio and prudent portfolio as we go for a consistent long-term return for the client.
Okay, follow-up question, Emmanuel Phillips.
Just real quick on currency and how you're seeing the Canadian dollar reacting to all of this. It seems to be a little bit different than in at previous times when we've had 100 and some odd barrel at WTI. So if you could talk a little bit about that and how we can better understand that dynamic.
Yeah, I will comment on this. Canadian dollar dynamic is sometimes there's a question about the Canadian dollar itself or the US dollar. In this case, with the geopolitical concern, the Russian-Ukraine situation, the China economics backdrop, US dollar is the safe haven asset. That flight to quality as such, US is very strong versus the rest of the world in terms of currency. But with this backdrop, Canadian dollar, especially with the energy prices concern, and is actually extremely strong. And out of all the foreign currency versus the USD, Canadian dollar is actually one of the strongest dollar performing in this cycle. So which is very good to see, good for the Canadian market and good for the Canadian backdrop in general. This is similar to what you see in other commodity heavy countries such as Canada, Australia, and this is the backdrop we are seeing out there.
Okay, thank you very much. Our next question will come from MLA Allard.
Thank you, Mr. Chair. Good morning. Thank you for being here. I'm just going to go back to some of the basics from the start of your report. Page 1 of the report states that the Heritage Savings Trust Fund returned 6% during 2021-22 third quarter and has outperformed its passive benchmark by 1.5%. What factors would you say explain the differences in return between the fund and the benchmark over the last year, and are those changing given the stagflation environment that we find, or potentially that we find ourselves in?
Sure, I'll start on that. In terms of that quarter in particular, we saw strong returns in the asset markets, benefiting from a recovery in economic activity, relatively easy monetary conditions, and strong growth in profits and earnings. And so typically we saw most risk assets, both across the public side and the private side, actually performing really well. We saw on the private side a number of investments which were actually exited or IPO'd and benefited from that in terms of the market actually realizing the investment value and distributing that back. So those were some positive perspectives. One of the things we've actually, as we moved through last year, we became increasingly cautious in the portfolio positioning and so rebalanced both on the public side and the private side too, but certainly in the public equities, which is a big part of the book, that is more defensively positioned. So going from being more pro-growth, positive market outlook has become a little more cautious. And so we reduced our equity exposure and we reduced the equity beta, we reduced the equity risk, increased the quality of that. And so actually what we've seen year to date in a market that's sold off double digits, we've actually been able to add value in that environment as well. So I think it's probably been actually a really good environment for active managers to be able to participate in that recovery and make sure that we're getting paid for the risk we're taking on, but as we've moved through the cycle to become more cautious and actually be able to navigate this in a reasonably robust way, at least to date.
Okay, thank you very much. Follow-up?
Yeah, thank you. I note in the opening remarks that the 5-year and 10-year returns were very solid and they both achieved higher than the benchmark. I'm just wondering, again, in this current situation, one of the benchmarks that I understand was more challenging to achieve was that additional 1% active management increase. And I'm wondering, given how volatile the markets are, if there's opportunity there, or how realistic is that goal right now? I know that sometimes that provides some opportunity for some arbitrage that was unexpected, but timing is everything, and I don't know how nimble the fund is to move assets quickly. So I was just curious how realistic that is given this environment.
Well, maybe I will address that. Thanks for the question. And I think the 100 basis point of the target is more a longer term target that we have the target for. And like the opening remark, Lo has shared with you, this is a tall order of the target. And I will share with you this type of target is almost like a top decile long-term fund performance that's expecting. So as such, this is really a target, and it's a very target challenging. But at the same time, for the 10 years we deliver so far, we actually deliver 70 basis point. But yet with the market getting more volatile, and this is more a stretch target we are shooting for. So as the market continues to evolve, and target of what we are achieving is one side of the equation. However, for AIMCO role to deliver the good risk-adjusted return on behalf of the client, we are laser focused on different investment, different cycle, different backdrop. We continue to be dynamically changing our investment strategy, portfolio construction, with the attempt to deliver this type of good performance and value for the client, despite of different economic backdrop we are facing.
I'll just quickly add one or two other aspects which are really important in this context. So as an investment manager, it is really important that we are looking beyond the here and now. The 70 basis points we're very proud of, but that's in the rearview mirror. So looking at new ways of building portfolios, looking at incorporating newer technologies which are state of the art in terms of how we are looking at data, how we're handling data, and secondly, again, continuing to look at the entire globe as the opportunity set rather than in a narrow way. And we've done that in the past, and we'll continue to push to do that in future as well. Thank you.
Okay, thank you very much. Oh, go ahead.
The other final comment, if I can, just on this market volatility. I think our focus is really trying to understand the difference between what is the underlying fundamental value and how the market is pricing it. And so really just try and not necessarily time those markets and add value a lot that way, but really focus if we have opportunities, and we've seen this particularly on the private side, where somebody is offering to buy some of our assets at what we think is an inflated price, we're willing to sell them. And if somebody's willing to sell something well below fair value, we're willing to buy that. And so really just thinking about the natural evolution and volatility. I mean, it sounds very simple, but to try and sell high and buy low, just as you work through that volatility period. And you saw a number of investments that we realized last year, which we sold sooner than we would have expected, but that was partly because the offers were really, really attractive.
All right, thank you. Good answers. MLA Egan.
Thanks, Chair, and thanks everyone for your report. I would like to talk about valuations to some degree. Clearly, you had quite a good quarter, and at least to some degree, that was buttressed by private equity holdings and space. But I also know that private equity is kind of hard to value, right? Because the markets are less liquid and so forth. And so I'm just curious to know how you backstop your valuations for private equity. How do investment managers like AIMCO go through a valuing process for those holdings, and do you contract out some of that to help with your valuations?
Okay, this is obviously a really important topic and a really important question. For us, the starting point is making sure that we want to have those valuations reflect fair value, and we want to have appropriate governance and oversight. So the starting point is that actually the investment team has nothing to do with the valuations. We might have our opinion of what we think value is, but the valuation process is run independently. That valuations team reports into the CFO. And so they run a rigorous process around valuations, and that is done really to try and establish the fair economic value of the asset. And they have multiple approaches. They are using external parties to help validate and make recommendations on those valuations. So it is trying to fulfill the purposes of independence, working with external parties. So there's kind of two levels. One, using external vendors to appraise assets. And second, even internally within AIMCO, it's run as a separate process under the CFO. and then that goes up to the board. And so that valuation committee, there's a valuation committee that's chaired by the CFO. They report into the audit committee and have some independent view there. Typically, those assets are use multiple approaches. They think about the income, they think about a market-based approach, and they look at a cost-based approach. The frequency of valuation process differs depending on the asset, but it's suffice to say it's a regular with market practice in that perspective. The other comments maybe I'll make as it relates to perhaps some of the thoughts and concerns. The private equity returns last year, which we think were abnormally good, was really a function of liquidating a number of assets. So the comments I made a little bit earlier, if somebody comes in and actually offers you to buy the asset at a price, you would sell it. And so there was a couple maybe investments worth touching on. So one was Hayward, which was actually an IPO. So this wasn't us really appraising the value of the investment. The IPO happens and it gets priced by the market. So it's actually transaction based, and then it becomes a public market mark to market. So that's not necessarily our assumptions. And there was another one on ERM, which was also a transaction where we sold the asset to KKR. So those were some of that. A reasonable proportion of that investment performance was actually not a changing in valuation methodology or change in valuations. It was actually investments exited, and they were exited at a premium that helped drive the performance. And the bulk of the valuation or the return wasn't from a change in valuation methodology or approach. A lot of it was actually the underlying performance of the investments and the assets in terms of growth of revenues and growth of profitability.
Thank you. No, I think that kind of answers my supplemental as well. I mean, I just want to make sure there's like a check and a balance in to guard against systematically mispricing these things. But clearly, if you are using some external sources or doing an audit that includes other opinions, then I think that is the way to go, obviously. So yes, that's all I got.
You're good. Okay. Next we'll go to MLA Jones.
Thank you, and thank you for your presentation. Inflation proofing is required by legislation to protect the fund from losing real purchasing power over time. Can you provide the amounts the General Revenue Fund is projected to receive from the income generated this fiscal year and the amount that will be retained for inflation purposes?
There we go. We only have numbers up to the end of December. We have not yet calculated the final numbers for the year. The report, as I mentioned before, says that we've earned about $2 billion through the third quarter. Approximately $440 million would be retained by the fund, meaning that approximately $1.6 billion will be transferred to the General Revenue Fund.
Yeah, and now specifically, can you explain how this amount is calculated, or what is the mechanism? How do we determine what is retained for inflation proofing? And then also, do we expect smaller transfers to the General Revenue Fund going forward as more is essentially required to be retained for inflation proofing?
So the inflation proofing is calculated by multiplying the consumer price index over the last 12 months by the value of the fund. So certainly, if the consumer price index continues to go up, we will have to draw more out. Assuming the returns stay around the same and not increase because of inflation, yes, we'll be drawing out less.
Okay, second question. The minister set a real return expectation for the fund, which I believe is 4.5% greater than inflation over a 5-year period. So simple first question, what was the return on the Heritage Fund over the last 5 years, and how did that compare to that target real return?
So the return over 5 years was 8.8%, and the CPI plus 4.5 was 6.3%. So we're about 250 basis points, 2.5% above our target.
And again, can you explain how this target is determined, how frequently it's revisited, and comment on the appropriateness of the target given that inflation is rising so rapidly?
Good questions. Historically, this was set when AIMCO was first created, and probably before that, when the fund was created. It was based on what endowments in Canada, university endowments, for example, expect over the long term from a real rate of return perspective. We believe it's reasonable, but it is, again, going to be challenging in the next few years as inflation takes off. You're going to have returns probably pressured downward as prices go up, or rates go up, pardon me, and you will have the opposite happening, inflation going up and the requirement being pushed up. So,
thank you.
And a quick second supplemental. Do other funds that have similar mechanisms use some form of more variable number? I mean, 4.5 is just a static number over inflation. So I'm wondering if there's some weighted averages or something that other funds are using that are more appropriate to the changing circumstances, because I imagine this would be very difficult to hit.
well, other endowments, it is common for other endowments to take the last 3 years average value of the fund. So it's actually, if the fund is growing, you're actually not transferring 4.5%, but 4.5% of a lower average. That's one thing. Some funds, and you'll hear about some university endowments, when returns are off, they will cut the contributions from the funds, their endowment funds, going into the university's budget. So they have flexibility, as would the government in this case. There is no law saying that we have to retain all the income, or pardon me, we have to retain income. That is part of the law, but there's no law saying that we can't disperse more than otherwise, or less than otherwise.
Thank you.
Thank you. Those are my questions.
Thank you. Yeah, just for future reference, we'll have one question and then a supplemental, but our next questioner is MLA Gray, and if you have two, then we'll allow you 2 supplementals.
Appreciate that, Chair.
We don't want to be unfair.
No, thank you very much. And thank you, everyone, for your presentation so far this morning, and lots of really good discussion at the meeting today. And I do want to acknowledge the very positive turnaround we're seeing recently at AIMCO, the strong performance over the last quarter and beyond. Certainly, we've talked in this committee many times about our view that AIMCO should be delivering benchmark returns plus 1%. And even during this meeting, we've talked about those value add targets as being, I think the language I've heard is very tough and a tall order. Over 10 years, you're at 70% of that target, and over the last 5 years, you're at 40%. And so certainly in the short term, we're seeing really positive things and a definite turnaround. But with that 40% and 70%, we're still not quite there. So my first question for AIMCO is really at a high level, what do you think is going right with the organization right now that has led to the recent improvement in these results?
Yeah, I can comment on that. I mean, I think the first point is that we are a long-term investor, and even though 5 years seems like a long time in the scheme of the variability of markets, it can be a shorter time. And so I think as we set some of these objectives and measure the CPI plus 450 over a 5-year rolling average, the idea is to smooth out those any particular year and get you a longer term value add. So I think certainly as a long-term investor, being able to have the fortitude and focus on the long horizon and hold the line even when there's pressure has proven to be very valuable. And we saw that in the results there. I think we should certainly give credit to Dale McMasters, the CIO, and the whole investment team for actually being able to navigate through what was a really challenging time and be able to come out of that delivering the amazing results they did in the previous year. So I think that's something to make sure it's making the right decisions when it's actually really difficult that counts. And so I think the investment team navigated that really well, and that also helps build confidence and conviction in the overall strategy with time. So I think that's one piece. The second part of this is what we're also observing is as the capital markets are evolving and changing, the role of private investments is increasing at a rapid rate, and that is providing significant opportunities to capture investments that may not be priced in the public markets, and is an opportunity for greater value add. And so that's something we've been investing in for years and will continue to invest in, is building out those programs across infrastructure, across private equity, across private debt and loans. Those are some areas that we have, if you go back far, 5 years or more, we had very little in private debt and loans. That's grown to be a significant part of the portfolio and has delivered outstanding results and is really well aligned with the investment objective. So I think as a team and an organization, we continue to invest in some of the asset classes and some of the areas where we think we have a greater chance of adding value. We have, as an organization, been focused on making sure we build the right team and culture to deliver on that proposition. And certainly as part of Sandra and I's mandate for leading the investment team is thinking carefully about that platform and the investment strategy. And what are the things that are going to be really important for us over the next 5 and 10 years to be able to deliver value. And I think we're excited and the team's excited of really leaning into some of those things, investing in the talent, investing in some of the technology and data that supports our platform, continue to globalize our geographic expansion are all going to be really important drivers of success in the future.
Oh, thank you very much for that. And certainly, I think we're very pleased to see the short-term positivity. Very interested in, as a long-term investor, seeing AIMCO beating that benchmark by 1% and keeping that as our expectation. Are there any obstacles that you can identify to hitting that benchmark return? Certainly, you've talked about needing to the work that's happening to update team and culture, the role of private investments. Are there any barriers or obstacles that you see looking at that perspective as a long-term investor to hitting the benchmark and beating that benchmark by 1%?
I think maybe just responding to some of your thoughts there. I think the capital markets are competitive, and the industry is competitive, and so I think certainly we're competing for talent, and we're competing for opportunities in the capital markets, and so having the best people in place, having the systems and the data and the technology to support that is critical, and being able to do that better than the competing organizations is really important. And so we're really focused on developing our unique culture, the talent pool, but also the infrastructure to execute on that. And then I would add one other piece, which I think a lot of people have been thinking about, is just the role of climate change and the energy transition, what that means for the underlying economy and what opportunities that presents and what risks that poses for people. That is also going to be a big area where there's a lot of unknowns today, And we're learning more every day about that. And, we're taking an investment-led approach on that. But I think that will also be, a big unknown or big theme that will be playing its part over the coming years that we at AIMCO need to make sure we, well-versed and educated and understand.
I guess one of the most important critical mission to achieve the target and is every cycle of the market and every cell of the market is just create a lot of good opportunity. Critical to our success is being able to be nimble, flexible, with the right talent and the culture to look beyond what the market is showing us today and look for new investment idea and thesis. And that's what AIMCO is always strive for. Like James alluded to, for the future state of what is the strategy to fight for inflation, better technology will continue to be the theme. So the team has continued to be working hard to identify new thesis, to continue to add value for the client, because the backdrop will just create more opportunity for a flexible investor to gain a better risk-adjusted return for the client.
And if I may, thank you. So I may be hearing you too literally, because I used to be a database developer and programmer. And when you're talking about technology and infrastructure at these committee meetings in the past, I understood that AIMCO was undergoing some major IT projects to update your systems. Am I understanding that you are literally connecting that to your ability to hit these targets? And would you be able to let us know if those major IT projects, which we talked about, I'm going to guess probably half a year ago, maybe a bit longer ago, have those successfully concluded, or are they ongoing? Because I think our understanding was that there were some projects that had really been going on for quite a long time. And if you can report back to that.
Sure. So the first point is, I think you're absolutely right that from an investment perspective, we think to be able to make higher quality decisions and make them in a more timely manner, the underlying data and technology is a critical part of that in supporting our portfolio managers and our research analysts for making the right decisions in a timely manner. And so it's a critical part of our strategy. And it's something we have invested in and something that we will continue to invest in. There were a number of projects which you may be referring to, particularly on the risk side, which were concluded and went live basically of January of this year. So that was a big effort and big investment made over multiple years. So that was successfully concluded and implemented. And it's suffice to say that we're kind of in moving to the next chapter of that. And the conversation that we're having, we're excited that we have a new chief technology officer, who will be joining us later this week, I believe, as a first official day. And they will be an important partner to work with the investment team to help think about how do we make sure that we have the right infrastructure and platform in place to support the investment decision making and portfolio management processes. So some of those have been closed off and complete, but this is going to be an active area for us over the coming years.
Yeah, just to add, we also have, in terms of some of the major projects, work ongoing to enhance and improve our performance and analytics system. So that's a process, that's a project that is ongoing, and will be delivered over time. But to echo James, this is an ongoing enhancement across the platform, in addition to some of the more visible systems deliverables. Thank you.
Okay, thank you very much. Our next question comes from MLA Singh.
Thank you, Chair. I would like to extend my appreciation for the presence of the representative from Ministry of Finance and AIMCO. And this has been a great and informative presentation and discussion. And my question is on page 10, that explains that there are 3 levels of fair value hierarchy to describe the quality and reliability of information used to estimate the fair value of investments. Level 1 would be the ones with the highest quality and reliability. And I see on page 10 that the real estate investments are the largest type of investments in the level 3 category. And what is AIMCO's confidence in the value of the fair a value, and how can we know the value is accurate and reliable? Thanks.
Yeah. So thank you for the question. With respect to all our investments, particularly the ones that don't have, effectively daily market-based pricing available, it becomes harder to estimate the fair value, right? There's no doubt about that. And so the way we approach that is particularly having one segregation of responsibility. So the person making the investment decision or being responsible for managing the portfolio has absolutely no say in what the valuation is determined. So the valuation is determined by an independent valuation committee that sits under the chief financial officer. That is so first certainly an independent process internally, but then they rely heavily on external appraisers to value those buildings or those investments and provide their recommendation. They typically use what would be called a market approach. Would be one of the approaches to get at a value or estimated value, where they would look at similar buildings, similar comparables, similar recent trends and other prices, and then try and infer that on a like-for-like basis and estimate it. So that would be called the market-based approach that they would use to do it. They would then use an income-based approach, which is looking at the underlying cash flows and rents and expenses and net operating income of the building to understand what are those incomes, what are they today, and how would we project them into the future, and then discount them to get back to a value. And then they would also look at a cost-based approach of like we own a building, and what would it cost to replace that and rebuild it in terms of a replacement cost. And then they use that to triangulate and say, okay, given these multiple approaches, what do we think is fair value? And so I certainly have confidence in the work that's done leveraging external third-party professional appraisers, but then the process that's done to actually review that. I've reviewed some of the minutes and the materials that go into the preparation for those meetings. They are very extensive, asset by asset. Each one is written up, is documented, is discussed in the valuation committee and approved. It's then audited independently. So there's an internal audit function that oversees the process to make sure that they're doing they're following the policy that's set. And then that goes up to the board, and the audit committee then evaluate those and audits to make sure that the valuation committee is actually doing what they're doing and that the assumptions are fair and valid in that process. So I actually have a high degree of confidence in the approach, and the process is it's almost confidence in the process and the policy and the approach as against any one number. And I think that's what's actually more important. We own hundreds of properties across geographies and across time. And so really having a robust approach to that is critical, because time will vary, the assets will vary, the market conditions will vary, but having a robust process for us is key. So I would say I have a high confidence in that, and that's something that is reported and publicly available if there's others that you would like to speak to on that topic.
Thanks for answering. And I see equity investments have a great potential of return compared to the other asset classes, but also poses a higher risk, especially global development ones. And what are the risks does the fund in equity investment face, and how does MCO manage such risk? Thank you.
Maybe I will take that question, and thanks for the question. Actually, equity risk, like the other any type of risk asset, is carry different kind of risk and return profile. And equity is no different than the other, is being impacted by different type of risks, such as the macroeconomic backdrop, country risk, sectors, industry, and actually even for the country or the company level of the metrics of the company, balance sheet, the industry they're in, and going into other type of risks such as demand, supply, technicality, fund flow, and liquidity premium all will impact the risk or the risk premium of what equity will earn over a risk-free interest rate. Now, that said, AIMCO is managing the equity risk like all the other risks we are managing within AIMCO with a full risk discipline approach. We approach a very full top-down, bottom-up approach with a prudent portfolio construction, diversification on how we set up a portfolio, with proper risk control and limit on how we manage the equity portfolio. When the team do the due diligence or actually invest for any single stock or any investment, we do a full bottom-up approach, looking at the company dynamic, the balance sheet and the health of the company, and that's all built in for a full approach that we look at the assessment. We never being complacent, continuously underwrite and stress test our portfolio and look at the portfolio from a broad stream of consideration. And when the timing is uncertain, and we constantly prudently put a hedge onto the portfolio to protect any risk that we want to protect during different economic spectrum. This is all being done with a full collaboration with the investment team and risk team, and built upon the strong governance and the risk culture and the collaboration between the risk and investment dynamic that we have within AIMCO.
Thanks for answering, Mr. Chair.
Thank you very much. Our next question comes from MLA Phillips and then MLA Hunter. Go ahead, MLA Phillips.
Thank you, and thanks for the answers so far. About a year and a half ago, I guess it was in the fall of 2020, it was sort of announced that there would be an investment review of AIMCO. And at the time, the CEO observed that the investment thesis and policy and allocation that derives from that policy comes from the government of Alberta. And the GOA indicated that they were doing an investment review. So I'm wondering from AIMCO's perspective, if you can tell me if there have been changes in asset allocation and overall investment policy as a result of that review.
So I can start, Sandra, and then if the Treasury Board and Finance team may want to add. So thank you for the question. That is work that is ongoing with the Treasury Board and team. We are taking a pretty broad, we are under their guidance, doing a fairly broad review of the asset allocation, including looking at different long-term forecast assumptions, looking at different configurations, different assumptions on inflation, etc., to develop insights and ultimately recommendations that the Treasury Board and Finance team would deliberate on and utilize as appropriate with them. It is a process that's ongoing right now, and we'll be happy to report from our perspective to the extent when it's complete.
Good. So at that time, there was some observation that perhaps switching to some aspects being passively managed. There was some chit chat around that. I'm wondering if you can provide me a little bit more insight into those deliberations. I can see where maybe in the first quarter of 2021, that looks good because equities are on a tear, but they're kind of not now. So can you just tell me a little bit about where you were looking at those passive approaches and where they'd be most beneficial in the kinds of market volatility that we're seeing now?
No, good question again. So we've been working with clients, the Heritage Fund team, in addition to other clients, on reviewing our investment platform. And one of the deeper dives was on the equity platform. And so we are going through a revamp, if you will, of the platform. One of the first set of deliverables of that review was the offering of indexed equity solutions, and those have been available on the platform for about 4 months or so now. The second part of the process is looking at, is reviewing the active equity solutions relative to what we had in the past, again, evolving them into a form that is more suitable given client feedback. And then lastly, an absolute return solution, which has also been on the desired list from some of our clients. In terms of the changes that are affected by this, most of the clients' sense is that they would look to assess the changes once the platform is ready, which it would be in the next by early part of Q4 this year. And last but not the least, outside of what's changing on our platform, which is underway, the big part of the asset class review typically is looking over a much longer horizon, and therefore working equally on what the right mix is, in addition to what the right vehicles are. So the first part of the process, that's the review that I was referring to, that's ongoing. The vehicles is, if you will, a second aspect to the review.
Okay, thank you very much. Our next question comes from MLA Hunter.
Thank you, Mr. Chair, and thank you, AIMCO and Treasury Board for being here today to present. I want to just ask a question about the Russia invasion of Ukraine and how that's affecting your investment strategy. Now, you did talk about divesting from any Russian assets. How has that affected the fund? What was the amount that was divested? Can that be presented here today?
Yeah, I will address the question, and thanks for the question. Actually, Russian-Ukraine situation and IMCO has relatively non-material exposure to Ukraine and limited exposure to Russia. When the situation evolved, we actually, in most of the exposure is in the public equity position, more reflecting the Russia index exposure within the index composite. So the exposure of Russia at that time is pretty minimum, close to maybe less than 20 basis point within the equity portfolio, translates to maybe 5-6 basis point of the total fund level. So it's relatively immaterial. And we actually also addressed soon after the divestment plan of the Russian exposure. So that was the action being taken. And I would also say that how it impacts the portfolio, we look at it in different perspective. The direct exposure of Russia or the second derivative of any other holding that have some second derivative of the exposure to Russia. And the exposure is pretty minimum, and we constantly monitor that as well. How it impacts the portfolio, and I would say before the Russian event happened, we are very mindful and cautious with the geopolitical event anyway, like James alluded to. As such, we really construct our portfolio as a very defensive, being underweight in stock and being underweight in bond and going into the market condition. So we actually position ourselves pretty well when we go into the Russian-Ukraine situation. And even with the risk of further inflation, stagflation risk coming up, and what we alluded to, we have been constantly evolving the market backdrop with this type of geopolitical event and position our portfolio accordingly to mitigate any potential risk or any economic uncertainty. And other risk monitoring, we have been monitoring the liquidity risk of the market, the function of the financial stability of the market, and make sure the liquidity is in good shape of the market, and also consistently stress test our portfolio and to make sure we stay on top of the portfolio or every single investment we are on.
Okay, thank you. I appreciate that. What would the risk be to our portfolio if we had to divest from China? Now, obviously that is a difficult question to ask, but given some of the geopolitical talk that we've heard, I'm just interested to know how that would affect our fund.
In terms of divestment in China, and it's actually a very interesting topic in discussion. So far, the fund direct exposure to China is relatively minimum. I think the exposure to direct to China is about less than probably 1% or even 70 basis point or so. This is the investment in China. However, how big China is as a country, or actually into the rest of the world, how it connected together. The second derivative of China exposure is more pronounced, is any portfolio. Any company will have any relationship with China, any supply chain relationship with China, that will be more of the second derivative of the exposure will be more worth considering. So as far as direct interaction with China or direct investment in China, the fund actually have a relatively small position in China direct.
Thank you. Our next question comes from MLA Agan, and then we'll go to MLA Rain. Go ahead.
Thanks. Thank you, Chair. And I would like to ask anybody who would answer about cryptocurrency. We hear a lot about it these days. And quite frankly, I'm confused, and maybe other people are too, right? So I'm just curious, on a basic level, if there is any, or what portion of the fund is allocated to cryptocurrency. I hear people talking about using cryptocurrency as a hedge against inflation, right? So I know that you are one of our largest portfolio managers in the country. I'm just curious what your opinion is on this. And what why do funds not invest in cryptocurrency such as AIMCO as a principal asset class? What insight can you perhaps provide for us here this morning?
I can start.
I guess I could start.
Okay. I think we got.
Excuse me. We have
Okay,
Lowell
perfect.
going first, and then we'll come back to you. Sorry.
I can answer the first part of the question, which is any allocation made to cryptocurrency? No allocation formally is made to cryptocurrency. So.
Yeah, I thought so, and maybe James can tell us why.
Is that the billion-dollar question? Look, I think it's obviously a rapidly evolving landscape in that space, and I think certainly from the perspective of an asset allocation perspective and investment strategy perspective, it's hard to argue that it would meet many of the criteria that we would use to evaluate the investment. And that it would be a good, it would have fundamental value associated with it. So I think it's something that is not actually, it's not in the portfolio, but it's not on the to-do list either of something that we feel like we really have to have as a part of the portfolio. There is an aspect, and this is, I guess, less about the crypto and more about the blockchain. And more about decentralized finance and how that evolves. So it is something that is rapidly evolving. The regulators and the banks don't seem to have a problem with it, and the speed and the requirements around regulation and transparency and all the things that are required for a good, robust financial and banking system. The fact that people can go and issue their own currency effectively, doesn't have any kind of sovereign attributes or any ability to regulate it or any legal protection to regulate it seems is somewhat challenging to me. But the underlying technology of being able to reduce cost of transactions, provide increased transparency, provide increased interoperability are all features that are attractive. And so I think as we think through the financial system, it's having implications in terms of asset exchanges, asset registers, insurance industry, you name it across the board. And so I think it is something that is worth staying on top of and learning and understanding what those implications are. But certainly as a standalone asset, it strikes me as more speculative than a true investment at this stage.
Yeah, no, I concur. And I mean, certainly couldn't you learn some of those best practices and fluidity, attributes of cryptocurrency without having to, detach an investment, especially a public investment like AIMCO, from a sovereign currency? I mean, it just seems to be defying gravity. You answered the question to some degree, but if you were in a position where you were compelled to invest in cryptocurrency, would you advise, what would your advice be, right? I mean, is it a place where AIMCO or public monies should be invested in at this point?
Well, I guess the answer would be, I do not believe it's a place that we should be invested in currently. I mean, I think that's the simple answer to that.
All right, thank you. A pretty short answer. Yeah, you betcha. Okay, MLA Rain, you're next.
He's muted. I don't know.
Is he muted? Oh. Are you talking? Okay. Maybe we'll go on to MLA Allard, and then we'll come back to Pat after.
Sure. Thank you, Chair. Again, thank you for being here this morning. These questions are a little bit more broad and historical, just for the benefit of Albertans who ask these questions often of MLAs. So we often get compared to Norway in terms of how the fund has performed and how the fund has grown or how the fund has not grown. But it's a very different thing. We're a state or a province versus a country. And so just for clarity for those that ask these questions, how much has been transferred to the general fund over the fund's life? Do we have that information? It may be coming from Lowell. And I know this is more a government question, and it depends on the government of the day, but what are the funds generally used for? I think I get those questions quite a lot as a member of this committee, just for the benefit of the public.
So approximately 42 billion has been transferred, I believe. Is that correct?
45.8 as of last.
45.8, I stand corrected, as of last year. What is it used for? Well, it's used as part of the general revenues of government, so it's used for the same things as tax revenues are used, or any other revenue from government. So schools, hospitals, social services, et cetera.
Perfect. Thank you. And if I can follow up, Mr. Chair. Again, drawing back on that comparison between Alberta and Norway, which comes up quite regularly as a member of this committee. Unfortunately, I answer that question far too often. I guess one of the questions I get is, what would the size of the fund be had governments of the past not decided to put it into general revenue? And I know that's sort of theoretical because it depends on rates of return and a whole bunch of other things that, we have that data in hindsight, but there was a lot of decisions that were made that we can't undo. And so is there a general estimate of the potential size of the fund if all of that income that had been generated had remained in the fund and had grown with the fund?
We don't do those kinds of estimates because there are so many assumptions you would have to make. For instance, you have to think about what else would have changed had we kept more in the Heritage Fund. For instance, taxes might have gone up. And if taxes had gone up, oil companies may not have invested as much in Alberta, leading to less royalties. That's a simple example. But you have to make assumptions on what other things change and how that would have impacted the fund. And it's just too many assumptions to come up with anything accurate.
Perfect. Thank you, Mr. Chair. I think it's, I appreciate the answer because it is a very complicated question. And, there's a bit of a domino effect in terms of if, then what else would have happened. So I appreciate that. I think that's all I have at this time. Thank you, Mr. Chair.
Thank you very much. Our next question comes from MLA Gray.
Thank you very much, and thank you, everyone. This has been a lot of really good discussion this morning. This is a little bit of a slightly different direction, but there's been a long tradition in Canada that elected leaders don't bring the decisions of the Bank of Canada into the political arena. But in the last little while, it seems like that tradition might be changing. Central bank policy has enormous impacts on both the fund and capital markets and generally. Nationally, we've seen some of our politicians, one of the contenders for leader of the official opposition, calling for the governor to be fired. Provincially, the Minister of Finance has certainly taken some shots, made some comments, implied that the decision-making at the bank has been a big problem. And we know that the bank's decisions impact the fund. So my question to both TBF and AIMCO, through the pandemic and the extraordinary decisions the Bank of Canada has made, what would be your assessment of their performance? And then further to that, to TBF, as the spokesperson for the Government of Alberta, what is the government's position on removing the Governor of the Bank of Canada? And can you share more fulsomely the government's position given the minister's repeated comments during question period?
Well, I can answer the second part, and there is no official position of the government. We have done no analysis in my division of the impact of changing the governor or anything along those lines. Sandra?
Yeah, I will quickly comment on the central bank in general. I think the central bank strike for independence on the assessment, and just looking at the backdrop over the last couple of years, is a difficult task for any central bank because of the backdrop we are seeing with the COVID situation, inflation pressure, and whether inflation being transitory is a constantly challenge that central bank have to adjust with the dual mandate of the employment level and also price stability. So I think the central bank over the last couple of years, they are really in the most difficult task to achieve those objectives. And not to mention, just in the middle of the COVID, we also have the Russian-Ukraine situation further introduce more pressure into inflation. So this is a very difficult task that the central bank facing right now, whether the monetary policy or the pace, the increased interest rate can be too fast, too soon, or too aggressive, can actually drag the economy into recession. So I think it's right now, it's too early to say if they're doing a good job or not a good job, but I have to say it's actually a challenging task. And not to mention, in Canada, we also have a housing market concern. If the interest rate is being increased too fast, too soon to control inflation, then we have a second problem that in Canadian market we have to deal with. Simply to put, is the housing market condition. So I think the central bank is a very challenging position, and really have a lot of wait and see approach and to see how they deliver going forward.
No, thank you. I appreciate that. And I think you're absolutely correct about it being a very challenging position. And I appreciate that Mr. Epps' division has done no analysis. But the minister is commenting and is commenting in public. And so my question is, understanding we can't necessarily have a full answer at this point, would it be possible for the department to follow up in writing? And of course, confer with the minister, just to let the committee know if what the government of Alberta's position on removing the governor of the Bank of Canada is, why the government of Alberta has broken the contemporary decision of not making comments on central bank decision making, and if the goal is a change in central bank policy, what the preferred change in direction would be and what impact that might have for the Heritage Fund.
Those are going to be fun to answer, especially that last one. We will do so.
Thank you so much. Thank you.
Thank you. Any other questions? I have no one on the list right at this moment. So
Pat Rain again.
Pat.
Hi. There you go.
Emily Rain. Okay, go ahead.
Yes.
Yeah.
Yeah. like to thank everyone for attending this morning and having this informative discussion with us. I would like to know about interest rates, inflation increases. How do you see these affecting your investment strategies going forward?
I think for the inflation environment and interest rate, we are no doubt in a higher inflation rate environment and even a higher rate environment that potentially the central bank attempt to control inflation. Now, our base case scenario, probably the inflation may be over the getting a peak level. And after all, interest rate being 3% is getting to a level that may be able to control inflation. But that said, it's still a little bit of uncertainty on the market and how it will unfold over time. So as James alluded to earlier, we are basically very disciplinedly managing our asset back with the backdrop of this environment. To position ourselves for a higher interest rate, we have been staying away from a longer duration asset, focusing on a floating rate asset. We have also been actively moving away fixed income and technically underweight in fixed income on behalf of the client. Higher interest rate may also impact more volatility in the equity market. As such, we have also been more underweight in equity allocation, prudently putting tail hedge into the portfolio because higher rate, higher inflation just introduce more volatility into the market. We also actively shift most of the asset, a lot of asset, and prudently looking for illiquid assets to protect for inflation, such as infrastructure and real estate asset classes to protect for inflation. And last but not least, when the team is looking for the underlying investment, we tend to focus a lot of more inflation-proof asset, and some of the investment is more tilted towards value, quality, and strong cash flow. That will be protect the portfolio and go over the long term, especially with the recent sell of the market, is actually a more prudent, better risk-adjusted value we find to invest on behalf of our client.
If I can add comments, I think the one piece as we grapple through, rising or high inflation and rising interest rates is how that gets connected to growth, right? And I think we can all realize that whether when you go to the pump, gas is more expensive and it eats into disposable incomes. And so as rates rise and inflation rises, it is a drag on growth. And that is the big question, is to what extent does the recovery from COVID offset and the positive momentum in the economy, to what extent does that wane? Because as your growth falls, that impacts the valuation of your risk assets, whether that be the real estate market or underlying companies and company profitability. And so that is certainly one of the risks that we're closely evaluating and thinking about in the portfolio strategy. And one of the reasons why we focused on trying to earn higher quality assets and less leverage and things like that in the portfolios to navigate a slowing growth environment.
Thank you.
Mallory, go ahead.
Yeah, I have two questions left. So my second last question is, have there been specific sectors that you have been divesting in, and why?
I'm not sure whether there would be sort of divesting necessarily, but there's certainly, in any given period, there'll be some industries or sectors where we're reducing our position and others where we're increasing our position as against divesting. So we're not explicitly divesting of any sectors, but certainly our overweights and underweights will vary as we navigate through time and as we kind of consider that risk-reward trade-off.
And I would say AIMCO actually have a internal responsible investment policy. So there are some sector we are not investing in, such as tobacco and some of the weapon industry that is under our policy that we will not invest in. And like I addressed earlier, the recent divestment of Russia is the recent decision we make of divesting from this segment. As the market continues to evolve, the world continues to evolve, we will continue continues to visit that. However, our choice and our policy on a lot of segment is more voice over exit. We believe in making the good impact and influence on some company, on some segment. It will be more impactful than just divesting. So we will continue to follow any development closely and make the prudent decision and the policy as we go.
MLA Rain, we'll come back. I know you said you had another question, but we'll go to MLA Egan now, and we'll come back to MLA Rain for the final question.
Hey, thank you, Chair, and thank you for everyone's comments here this morning. They were quite refreshing. We've covered a lot of ground. Let me ask my last question as two parts together. Question for AIMCO and TBF. It's a bit personal, but I think it's interesting. I'm just curious to know what keeps you up at night when it comes to the fund. I know we've talked about lots of international uncertainty, but in further, I mean, what do you think some of the markets that we're missing right now, missing in terms of governance at IMCO, X factors that all of us, perhaps should pay mind to, and what can we do to help? Don't stay up all night when you can't go to sleep.
Well, I can start. As far as I'm concerned, in the short term, it would be equities. If you look at the 70s and when there was high inflation, equities did not perform well, a very low return through the decade. And so a low return through an entire decade sort of thing, well, it's what I worry about, and it would have a significant impact on the fund.
One on up there.
I echo what Lo mentioned, and my top risk is geopolitical risk that with the backdrop of Ukraine and Russia is actually take the geopolitical risk to the next level. Geopolitical risk, especially the relationship of China being the second biggest economy of the world and the biggest holder of U.S. reserve, this risk is top and front and center that what I say will keep me up at night because it will impact inflation risk, equity risk, interest rate risk, and every single risk metric we talk about. So, and we are seeing a massive trend of deglobalization, and it's still uncertain how this will unfold. And just watching the Russian-Ukraine situation, how sanction unfold, financial sanction or different type of sanction, I think the geopolitical risk of China and the rest of the relationship is something that I personally focus and a lot on.
I'll just add one quick point outside of market and investment risk. We're also, I mean, the other part that's really big is the risk that we have in terms of our employees as they go back post the pandemic into the new flex hybrid. It's a huge vocabulary that it's being described, and so we've, like many other organizations, we've taken a first step in that direction. But that is something that will be critical over the next little while as we move forward into this new world, so to speak. Thank you.
Thank you.
And I guess for me, when I can't sleep, I guess it's probably wondering whether we've had probably the last let's call it 4 decades now of a pretty robust growth. Low rates, low inflation, increasing asset prices, increasing valuation multiples, lots of prosperity, and whether we are indeed in some kind of inflection point where actually we have higher rates, lower growth, lower valuations, and less prosperity. And so I think that is a real risk and something that sort of keeps me up a little bit is like, are we actually sort of at a major inflection point? Or is this something that we can continue to sort of muddle through and get back on track of having, sort of reasonable economic growth and continue for the financial system to operate the way it is and not get disrupted and effectively increase the cost of capital?
Is that it? Yeah. Okay, ML Lorraine for your final question.
Yeah, thank you, Mr. Chair. Are there any specific sectors or companies that you're investing in that you're particularly bullish about, and why?
There is within the overall portfolio, especially for a potential rising rate environment, is actually prudent for a client, for especially a sectors on private credit market. The reason is makes sense because James alluded to, for a higher rates environment and volatile in equity market, and for last couple of decades of a higher return. We are going into maybe a lower return environment. But the benefit of private credit market is actually they are floating rate in nature, not sensitive to interest rate. And because they are private in nature, a lot of time is the manager can actually roll up the sleeves and better construct a deal with a strong protection behind, and with a prudent underwriting process can actually construct a very good, high quality, not sensitive to rates, a portfolio with a strong absolute return. Absolute return of maybe 5 or 6% of a portfolio is actually a very strong portfolio with the backdrop of the market we are seeing with low rate and a higher rate environment, maybe low return, single digit return of stock and bonds, and being even volatile market. So this segment is actually a constant developing segment of the market over the last many years. We have been actively involved in the market, and we have been consistently growing this market that really have a high conviction on. So I would say this is one thing that one of the segment that we like a lot, and we continue to encourage our client to look into this segment of the market.
Yeah. I would add to that some areas that we've been excited about. Certainly on the private equity side, we see a lot of businesses that are in that sweet spot of having established products and services and capability, but really growing and scaling that. So sort of in the mid-market buyouts and growth side, lots of good opportunities, particularly as the impact that software and technology are having on businesses and business models, and the ability to earn good profit margins and scale that across a big market opportunity. We continue to see all kinds of applications for technology and software solving real business problems in different industries. And so that's been an area that we've allocated capital to for a couple of years now, and I'll continue to be excited about. So I'd point to that as one. And the second one is with respect to real estate. We've also found and been excited about a number of opportunities where we've been investing in things like data centers, as well as thinking on the industrial property side, and logistics and industrial real estate has actually been another area which we have been investing in and are excited about in terms of how the economy transforms over time, and we're able to supply capital and invest in expanding those kinds of capabilities.
All right, thank you very much, MLA Rain. And that concludes our discussion on the report. I'd like to thank our guests from Treasury Board and Finance and AINCO for giving us very detailed explanations today and great answers to good questions. And now and also the Office of the Auditor General for being present here today as well. And you're welcome to leave the meeting now or remain if you would wish. So you can carry on your day if you want. Thank you very much.
Thank you, Mr. Chair. Thank you for giving me this.
Thank you.
Okay, I'll now look for a member to move a motion to receive the Fund's 2021-2022 third quarter report. MLA Egan? All in the room, all in favor?
Aye. We need to read the motion.
What's that?
We need to read the motion to the record.
Oh.
Someone needs to read
Oh, I'm sorry. Okay.
No problem.
MLA Egan, that the Standing Committee on the Alberta Heritage Savings Trust Fund received the 2021-2022 third quarter report on the Alberta Heritage Savings Trust Fund. So any discussion?
Yeah, open it up.
Open it up? No. Okay, online? Okay, thank you. In the room, all in favor? We'll do it again. Okay, any opposed? Online, all in favor?
Aye.
Aye.
Any opposed? Okay, that is carried. Okay, the annual report for the committee. The members, section 64C of the Alberta Heritage Savings Trust Fund Act requires the committee to report to the Legislative Assembly on whether the mission of the Heritage Fund is being fulfilled. The last report to the Assembly was made on June 1st, 2021, which covered the activities of the committee in 2020. The draft of this report was posted to the committee's internal website for members to review, and the report covers the activities of the committee during the 2021 calendar year. Do members have any questions or comments regarding the draft 2021 annual report of the committee? Hearing none, I'll look now for a member to move a motion to approve the draft report. MLA Allard, that the Standing Committee on the Alberta Heritage Savings Trust Fund approve the draft annual report of its activities during 2021. Any discussion? None? Okay. In the room, all in favor, say aye. Aye. Any opposed, say nay. Online, anyone in favor, say aye.
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 Anyone opposed, say nay. Okay. So that's carried. Yep, got her. Okay, other business. MLA Gray.
Thank you, Mr. Chair. I think as MLAs, we all know that the work we do could not happen without the support of the amazing people at the Legislative Assembly offices, and particularly the House Services team that supports the legislature in our committee business. And this morning, I found out that someone we've all relied on for a long, long time, our Committee Services Coordinator, Leah, this is her final committee meeting because she is moving on to new things. Leah, can I say where you're going? Sure. She's leaving us for AIMCO, guys. And I really just, on behalf of all the MLAs, all of us see the work that Leah and the others on the Research and Committee Services team do day in and day out, and we couldn't do what we do without your support. And Leah, in particular, is always just someone who brings a lot of joy and positivity to the work she does. And I'm particularly thinking about during estimates when she is flying nonstop to make sure all those simultaneous committee meetings are running smoothly. So on behalf of all of us, I just wanted to say thank you, Leah, for all the work that you've done over 10 years at the Legislative Assembly.
Well done. Thank you for that. That was nice. Yeah. Okay, the date of the next meeting will be at the call of the chair, and we will be to review the fund's annual report from the Treasury Board and Finance. If there's nothing else for the committee to consider, I'll call for a motion to adjourn. MLA Allard, that move that the meeting of the Standing Committee of Heritage Savings Trust Fund Committee be adjourned. All in favor? Aye. Online, all in favor?
Aye. Aye.
Any opposed anywhere? Okay, I guess we're good. So that's carried. And meeting adjourned. We'll see you at the next one that we're going to have. Thank you very much.